Hey there, everyone. Today on the Final Bar, happy Monday. We'll talk about the NASDAQ leading the way higher, finishing strong into the close, back above its 50-day moving average. We'll talk about one key technology stock with a bullish candle pattern that you should be aware of. Finally, we'll open the Final Bar Mailbag. Which moving averages are the most important? Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a warm and sunny Redmond, Washington. Thanks for joining us every weekday after the close, and happy Monday as we try to make sense of these markets during volatile and uncertain times. At the end of the day, I think the technical toolkit is really ideal for trying to make sense of things, as I would consider it as an individual investor, as a financial advisor, as an institutional investor. Regardless of what role you're playing, your goal is to understand the markets. And I would argue all of those people I just described should have a strong situational awareness, a good sense of what's happening in the markets. And I have found that with a consistent review of the charts, certain things every day, certain things every week, and certain things every month, you can have a really good handle on things. You will be surprised a lot less. You will be prepared a lot better. And you will certainly have a good sense of where things are at and have a much better sense of what may come next. Now, the general hypothesis or the general thesis we've been talking about is sort of this rotation, this leadership rotation. What I wrote on StockCharts.com on Friday's article, the Great Rotation of 2023, I think I'm comfortable now calling it. And one of our charts on Friday sort of highlighted that rotation away from growth leadership back into some of the cyclical sectors like energy and materials. Today, sort of a mean reversion to that theme for sure. Technology actually leading the way higher. The NASDAQ outperforming the Dow and the S&P. So a lot of interesting charts to talk about. I would argue that that general thesis is still in play, but today sort of lighter volume and a bit of mean reversion. Let's look at what that did to the charts as we get into our market recap. And before we get there, I do want to start with a poll question. We always have a poll running on our YouTube channel, on our social media accounts. So make sure you follow and subscribe where you can. We asked you recently, which technical indicator is not considered a trailing stop indicator? We gave you four choices: parabolic systems, exponential moving averages, a chandelier exit, or the relative strength index, or RSI. Now, using the process of elimination, if you can with me, parabolic systems, of course, we know isn't the answer, right? Because that is a lagging indicator. By design, Wells Wilder literally created it as a trailing stop indicator. The idea with a commodity was to ride the trend higher and to remain in that trade until the stop was triggered, and then you would stop and reverse your position. That's why those little asterisks on the parabolic system are actually called SAR points, for stop and reverse your position. Exponential moving averages and chandelier exits, similar idea. These are both designed to follow the trend but lag behind just a little bit, with the idea that as long as you remain above it in an uptrend or remain below it in a downtrend, that trend is in place. That leaves us with RSI, and RSI really is an oscillator. So when you think about different types of technical indicators, there are sort of different broad buckets, and I tend to start with leading indicators or lagging indicators. What indicators are designed to anticipate something's about to happen versus confirm that something just happened? I think both of those have a place, probably in your process. But then you have different types, right? Some different nuances in terms of how they're calculated and how they're derived. So if any of those did not ring a bell, particularly the chandelier exit, parabolic systems, these are some really interesting trend following devices and trailing stop indicators. Hit our chart school pages. They're free. They're accessible to all, and a really good way to learn some of the specifics behind those technical indicators, along with many, many others. Let's continue on with our show, with our market recap, and sort of dig into some of the themes that we saw today. As I mentioned, it's sort of a growth over value day, and that's contrary to what we've been talking about a lot recently. In recent weeks, it's been a lot about value over growth, particularly cyclical sectors, which are sort of like late leadership in a normal business cycle, normal market cycle. Sectors like energy and financials, which tend to do well at a certain point. Today, sort of the opposite. So the NASDAQ, actually the best performer of the three. The Dow was in the red until right in the close. You had a nice rally with equities in the last 30 minutes of trading, pushed everything toward the highs for the day, pushed the NASDAQ to finish up about 1% from Friday's close. The S&P up about 0.6%, right around 4490, and the Dow just slightly, narrowly, rounding error, kind of positive from Friday's close. So S&P still below 4,500. That's one of those big round numbers, sort of, general guiding levels we've been focused on. We still remain below there, even with today's little bounce. And the NASDAQ, the QQQ in particular, just getting above its 50-day moving average. I don't know if it actually closed above there or not. We'll look at that chart here in a few minutes and make that assessment together. Mid caps sort of flat for the day versus Friday's close. Small caps down though. Small caps down 0.5%. That's the S&P 600 closing just above 1237. The VIX actually moving higher, so back down below 15. We're at a 14 handle, 14.8 or so. So again, relative to the last 2 months, pretty high. Relative to the last 2 years, pretty low. So it depends on your look back, to be honest, in terms of how extreme you think the current reading is. I would say one of the big themes, I think, in the first half of the year was the market rotating higher and volatility in general lessening. I think the second half of the year, as we see more of corrective patterns, more price and time corrections, and an increase in volatility. I would say the average VIX in the second half of the year most likely higher than the first half of the year. That would be my guess, but we'll see. For now, hanging in there, not getting too high relative to what you might expect after we saw the break higher about a week or two ago. Looking at interest rates, overall rates moving higher again today. So the 10-year point finishing around 4.2%, just below that. The long bond yield just below 4.3%. The 5-year yield, the highest, right around just below 4.4%. So, again, you're seeing rates generally higher over time. Through the course of the last 3 to 6 months, we've seen an improvement in rates as bond prices have gone down. I've read a lot of speculation, have a lot of conversations about, the bond markets. And what's so interesting is I think so many investors are programmed, and it's been driven home so many times about, thinking about a balanced approach and having allocation to stocks and bonds. And bonds are perceived as a sort of a safe haven. So when equities, risk assets get kind of challenged, bonds are a little more stable. But what you're finding now is in uptrends and in downtrends for stocks, bonds are actually underperforming the whole time. So the stock to bond ratio is still just plunging up and to the right, continuing to outperform. So it's been a clear statement, I think, against bonds in general, and more about equities being a better place to be over time, right, over the long term. And you're seeing that here in bull and bear market phases. Dollar index up about 1/3%, not too different from where we were on Friday. Gold and silver prices continuing to go lower. Gold is actually testing a pretty key support level. We'll get to that chart if we can. I think the GLD is right at another Fibonacci support level, right at the 200-day. So an important level maybe to watch there. Gold's really been, I think, underperforming really expectations, right? When the equity market gets a little challenged, you usually think of safe havens like gold doing a little better than they are right now. Strong dollars really hurting the upside potential for gold, but the GLD and the SLV silver ETF, both down less than 0.5%, but down nonetheless. Energy prices overall down, with crude oil prices down a bit, gasoline as well. Finally, cryptocurrencies, kind of a weird shaped day. You saw a big spike higher in Bitcoin that came right back soon after. Bitcoin currently around 29,310, and Ethereum prices just below 1840. So again, still below those key kind of lines in the sand that we've talked about. In my opinion, with something like Bitcoin, you can speculate a lot about what may come next, and could Bitcoin double from here or go 50% lower, all those things. Those big, huge sort of targets are interesting as a discussion point, right? To think about what that could look like and what that might look like and what that might mean for different things. And I think that is actually a healthy discussion. But recognizing that before we get to 60,000, we'll have to cross 30,000. I think keeping your feet on the ground in terms of the short-term objectives and lines in the sand versus some of those longer-term, more aggressive targets can be really helpful. And the reason why I say that is, as long as Bitcoin's below 30,000, it's certainly not going to get to 60,000 yet. So in my mind, setting an alert about, all right, when this chart hits this, I'm going to revisit it. For me, Bitcoin 30,000 is the level, and we're not there yet. So at this point, I think of it as still a consolidation phase at best until we can break above resistance. We just haven't been able to do that in quite some time. I mentioned with sectors in the introduction, technology doing quite well today. The XLK was up 1.6%. NVDA had a nice up day. We'll look at that chart here in a few moments. You'll see what I mean. Some of the semiconductors, which have been struggling a lot recently, have bounced a little bit higher. Communication services, number 2, up about 0.8%. Healthcare and consumer discretionary tied for third place, up 0.3%. 5 of the 11 S&P sectors finished the day in the red. Utilities, real estate, consumer staples, 1, 2, 3 from the bottom of the list. So fairly defensive sectors at the bottom, kind of growth leadership at the top. This is definitely more of a mean reversion back to the type of pattern we've seen in the first half of this year. I think it's a little too early to say that's the end of the pullback. This is a one-day thing, but certainly an emerging theme potentially to pay attention to. Let's look at some of the individual charts that kind of put a day like this in a proper perspective. So the S&P 500 going into Friday or going into the weekend, it's all about testing the 50-day moving average. I think that's still pretty meaningful of a level. If you look at the 200-day, the 50-day moving average here in blue, it's currently around 44.43. You can see a trend line taking the March and the May lows right at that same level. So, while that trend line maybe not be the most important trend line of all the ones I could draw, the fact that it coincides with a moving average. So two different disciplines sort of locking into the same general place. That's why I think it could be a little more important than normal. So the fact that we're bouncing today off of that level of potential support, I don't think is unreasonable. That's actually, even if it's a much deeper drawdown from here, a bounce off of these levels this week would make a ton of sense. I think the real question is what that next move is, right? Do we keep making a lower low through the course of this week? Do we, really establish some support around 44.50, which is kind of right around the lows over the last couple of days? I think that would be the question for this week. For now, this market and this chart is looking like a pullback within an uptrend. And I say that because we've not broken those support levels yet. The momentum is actually remaining fairly strong. The RSI dipped, briefly below 50 last week, but it's actually right back above there today and certainly clearing 40, which is sort of my default, bullish, the lower end of the bullish threshold. And we have all these other levels of support that are below current levels that we're not anywhere near them yet. So we break the 50-day, we break kind of 44.50. I think we need to start talking about further downside objectives. I personally wouldn't be surprised if 41.50, 4,200 ends up sort of being the end of this corrective pattern over the next 6 weeks or so. But we'll see, right? To get to that point, we first have to break this level. And that's why I think this week we're kind of hitting on that level, the 50-day. A number of individual stocks, by the way, kind of testing their 50-day as well. And again, I think that's part of the benefit of looking at a top-level equity index like the S&P, and then looking at some of the individual stocks that comprise those indexes. This is why something like breadth analysis, I think, is so vital, because it's really trying to roll up charts like Lennar and other home builders and other consumer discretionary names and all the other stocks that comprise these big indexes and seeing what their individual experiences are, right? What are those individual charts telling you? Chart of Lennar Corp's testing its 50-day, just like the S&P is sort of just above its 50-day. Lennar is at the 50-day today. The Qs are just right at their 50-day as well. So, what's interesting, and the reason why I guess I have a little more conviction in further deterioration from here is that charts like Apple and Microsoft have already gone through this and have broken their 50-day. They did not hold at the 50-day. And so when stocks don't hold at the 50-day or the 10-week moving average, for me, that just sort of puts up this little red flag that makes me think, all right, we need to start, expecting, or at least, planning for further downside, what that might look like for the portfolio and how you'd sort of navigate around that period. I wouldn't be surprised again if I think the broader benchmarks continue a little further down than what we've seen so far. Now, the QQQ on Friday closed below its 50-day moving average. It was the first time we really gapped below there since back here in March, which is a brief test. It's really back here at the beginning of the year. Much of last year, the Qs spent below the 50-day moving average. So reversing above there in January, retesting it in February and March, then rotating higher. It was just a great illustration of the rotation from the distribution of last year to the accumulation phase of this year. But now we're sort of in a question mark period, right? Is this a March kind of low where we're briefly going below the 50-day before we make a new swing high? Or is this something like back here, January of 22, where we're retesting the 50-day from below before we really deteriorate much, much further? And that's why I think when a market is testing these key levels, that's why it's so meaningful. So the Qs with the 50-day, with the RSI right at 40, this is an important point. I think it fails here, and I think that's where you really need to start thinking about downside protection, what that might look like, how to layer out of positions, and all those sorts of fun things you need to think about if the market starts to really struggle to hold its ground. Now, when we think about market analysis, we can look at breadth. We can also look at some high-level analytical tools like Dow theory. Dow theory is really a macro strategy, just looking at two main parts of the economy. Charles Dow looked at the Dow Industrials and the Dow Railroads, what we now use as the Dow Transports. I sort of have adapted that to what I call a new Dow theory using the S&P and the NASDAQ composite. I think there's more to be done here. I think equal weighted versions of this probably a little bit better, but in either case, they're kind of similar, which is why I don't mind showing this one. The reason why I wanted to show this chart, now Dow theory in general basically tells you that when these indexes are both confirming new highs, conditions are bullish. When one of them does not confirm a new high, meaning the S&P makes a new high and the NASDAQ composite does not, or the opposite, NASDAQ makes a new high, the S&P does not, that's called a bearish non-confirmation. That means one part of the economy is doing just fine. The other one is saying, uh-oh, that's not quite as good as you think. And that usually happens at the end of a bull market phase. And you don't have to look much further than the left part of this chart at the 2021 to 2022 high, right? The S&P made a new high going into the end of the year. The NASDAQ composite, a lot of other indexes actually made a lower peak. Breadth and other tools were diverging as well. There are a lot of divergences in that period in particular, but this was, I think, the new Dow theory version of a bearish non-confirmation. I want to point out that we don't have that at this point. So it's not like this is a clear, like, Hindenburg omen, oh my gosh, this is the top type of pattern, which I think we got back there at the end of 2021. This is more of a tactical pullback until proven otherwise, right? I would give the benefit of the doubt to the overall trend still being constructive, given what I've seen so far. I just haven't seen enough of those extreme danger signs. Now, one of the things I think maybe that could validate what we've not seen yet is to see if levels are broken, right? So we talk about the S&P, the NASDAQ testing the 50-day moving average. That's totally fine. I think on top of that, take a trend line. This is using just the closing prices. So on the S&P, the October and March lows, you can see that currently gives you a level around 4,200, which means we can get all the way down to there. This still looks like a nice, pretty orderly uptrend. And that just shows you how much of a downswing you can have and still be within an uptrend phase. And that's why I think this chart is really good at just showing you, because we've had such a run, you actually have a lot more room below current levels and still be within, a decent uptrend. I wouldn't be surprised if that's kind of what the next, 3 to 6 months looks like. It's sort of a retest of this kind of trend line and then a rotation higher in the fourth quarter. That would make a ton of sense from a lot of different, certainly seasonal strategies and others as well. Now, the NASDAQ composite's a little bit closer. So you get below, 13,500 or so, depending on how quickly we would come down, and you break that same trend line. So again, that I think could be an issue where growth stocks really break down a little more significantly. Again, this puts further pressure on the S&P, which is still very growth oriented. And this is kind of the narrative that sort of is forming as I'm looking at these charts pretty regularly and just trying to see what we've seen so far and think about the logical next steps. Just to finish off our market recap here, that is not the chart I want to show you. There we go. Look at the chart of NVIDIA. I just want to highlight a big reversal day today. NVIDIA, one of the top stocks in the S&P today on an absolute basis, up just over 7%. This is a nice upside reversal. If you know your candle patterns, that is the bullish engulfing pattern. We have a downtrend, a down day on Friday, a big up day where today's range open to close engulfs the Fridays or the previous day's bar. That is a short-term reversal candle telling you the next 1 to 3 bars most likely higher than lower. Tells me maybe the first half of this week is a little more about an upside bounce for NVIDIA and other semiconductors. And you'll find those on other semiconductor names as well. MPWR, Monolithic Power Systems, showing the same thing. AMD, which is actually in that same group, same bullish engulfing pattern as well. So those types of patterns pop up. I expect short-term bounce to the upside. It seems to be what the first half of this week may be setting up to show us. We're going to, in a moment, bring up the Final Bar Mailbag, start digging into some of the questions you guys have sent in. Before we get there, just a couple quick announcements. First off, the mailbag is filled by people with people like you sending in your questions. What are you running into as you're analyzing charts, as you're trying to use the technical toolkit, as you're struggling with a market, certainly in a rotational period? Just let us know. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Of course, just put a comment below the video you're watching on our YouTube TV, our Stock Charts TV YouTube channel. We would love to hear from you, particularly your questions. We'll hope to answer your question on our next mailbag segment, which will be Friday of this week. Also, to let you know, this coming Wednesday, August 16th, 1 p.m. Eastern, 10 a.m. Pacific, we'll be doing our latest YouTube live Q&A. I'll be sitting in front of the charts. I'll share with you a couple charts that I'm focused on Wednesday afternoon, and then from there, we'd love to just get your questions real time. It's a lot of fun on YouTube. We've done a couple of these and have really started to have a really good time. So please join us live. That'll be this coming Wednesday, August 16th. 1 p.m. Eastern. If you go to our YouTube channel, make sure you subscribe. You'll see the placeholder for that live event. You can actually set a notification right from that video placeholder, and we'll hope to see you this coming Wednesday, the 16th at 1 p.m. Eastern. Let's get the Final Bar Mailbag open. Thanks again, everyone, for sending in your great questions. Please keep them coming. Let's get to question number one. Dave, can you comment on downside potential using the daily and weekly charts for HSY, which is Hershey? And you actually sent in permalinks with your question. Thank you so much for that, by the way. And as a reminder, when you're sending in questions to us, best thing you can do on stock charts, on our sharp charts, our main charts, click on permalink. That'll give you this little URL. Just copy that into an email, and I'll be able to see the live version of the chart that you're asking about. In our ACP platform, you just go to the lower left where it says share, and it'll ask you, do you want to share just that particular chart? Or if you're using a layout with 3 different charts, something like I'm doing, you can actually say share layout. That actually send me your entire little desktop there. And again, I can see a live version of it. It's really good for getting a sense of what you're looking at and answering your questions a little better. So, Hershey's looking at multiple timeframes. I think there's a lot of, again, I think there's great wisdom in the way you asked your question. When you're thinking about downside potential or upside potential, depending on the chart, looking at multiple timeframes can be really helpful. And there are a number of books that I think do a really good job of talking about that. Brian Shannon, who is known more recently for Anchored VWAP, which is a really, sort of interesting addition to the technical toolkit. He also wrote a book earlier on multiple timeframes. I think is really good. Joe Rabel, who hosts Stock Talk with Joe Rabel on Stock Charts TV, has also written a really well-done book on multiple timeframes. So I'd encourage you to check those out. If what I'm about to tell you doesn't quite make sense in terms of why comparing different timeframes can be so valuable, because it's all about your investment horizon and recognizing that there are different cycles at play at any given time. I would argue right now, you sort of have this rotation. We're in this secular bull market phase, which has been going on for 10, 15 plus years, depending on where you want to start the clock. 15 might be a little much, but we'll call it 10 to 12 years, right? A bull market phase. I would say at least from, 2013 when the S&P made its new high above 2000 and 2007, but you also have sort of the medium-term time frame. You have the short-term, the tactical time frame where there's been weakness in stock. So recognizing the interplay is really, really helpful. So I like how you're starting it. And what I would generally do is start bigger picture and go smaller. So I would start with the weekly chart and go to the daily. That's kind of the general way that I would progress through that if you're looking at downside targets. And to be honest with you, on a chart like Hershey's, I would start where we're at and look to the left. When you look at the daily and the weekly charts, and to be honest, I'm kind of getting to the punchline very quickly, I'm immediately keying in on these 2003 lows, right? And you can see how, even on the weekly chart, you can see this relatively stable support zone right around 210 to 215. We had a number of lows within about a 6-month period, all in that same point. So if this is my chart, which it's not, so apologies for drawing on your beautifully constructed chart, but I would immediately use the annotations tool. I would kind of draw lines right around here. And if that's really hard to see, which it is, you just want to make it like a lighter color. So you can go in here, if you like blue, for example, go in here and just make it a little lighter. I like using this. It's kind of a shaded area. I like thinking of it as a support zone and not a support level. I think the days of there being a precise, penny point where a stock hits and then you expect something, I think is pretty antiquated. I think thinking of it in terms of zones and recognizing an area at which the market tends to change its configuration, I think is a healthy way to think of it. So if you look at it that way, you can see we're getting really near that support level. Now on the daily chart, it's a little even more obvious. This is that same area we're talking about, sort of that 210 to 215 range, which tells me even though this has been a significant downtrend, which it has, even though we've broke below the top of this base, which we have. So I think, again, the trend is certainly negative here. When I'm thinking of downside objectives, recognizing that we're really close to a pretty important support level might be pretty meaningful. The other thing that I would start to do is look at Fibonacci retracements. And that's when something really gets to an extreme level, it can be helpful to, start drawing Fibonacci levels just to think about, all right, where did we start from? Where are we at now, right? Where did we recently top out? Where was the beginning of that move? and what kind of levels may be important on the way down. And what's interesting is, I mean, again, I'm just looking at this for the first time, but if you take the high from April, May of this year, which is when Hershey's topped out, if you take the COVID low, so this is the 2020 low here from March, 38.2% of the way down is right at 210.50, which happens to be right in the middle of that support level. So it sort of looks to me like you have a bit of a confluence of support right around that area. That is how I would be looking at the chart. Again, support levels and expected areas of buyers to come in. That's interesting, but at the end of the day, it's all about price and it's all about trend. As long as Hershey's keeps going down, I'm inclined to avoid until I see signs of accumulation. That area might be a place where you start to see that. Great question, by the way. And thanks for asking about multiple timeframes. I think it's a really important part of the technical approach. Next question, Dave, how far should we look back when drawing trend lines? That is a brilliant question. We'll stick with your charts of Hershey's person that sent these in there. I hope you don't mind. So to be honest with you, a lot of times I draw trend lines and don't talk too much about how I'm picking those particular levels. And here's what I would tell you. There's a reason there are some systems that try to do automatic trend lines, and I've seen them and I've experimented with them. I'm not a huge fan of them because for me, trend lines are kind of a conversation you're having with the chart. There are parts of the technical toolkit that are very objective, that are very systematic, that a number of us would look at them and should pretty much have the same conclusion, like a MACD or PPO, sort of a good example of that. It's like a buy signal is not open to a lot of interpretation. It's like, it's a buy signal. The signal was triggered. That's it. It's done, right? The chandelier exit, right? It hits the trigger, you're done. And there's benefit to that. Trend lines are a little more subjective. This is where a room of us all looking at the same chart could actually analyze it very differently because we put our trend lines in different places. So what I would say is the amount of time you want to bring in really depends on how far you're looking forward. And the general rule of thumb that I have is if you're looking, X time out, you want to look at about 6X, 6 times that amount of time going forward. So if I'm looking out 1 month, I want to have at least 6 months of data behind me. If I'm looking at 2 months, I want to have at least 12 months of data behind me in terms of what I'm looking at, the amount of data I'm considering to think about what might come next. And generally speaking, that's a good starting point, I think, for finding it. But what you will find, if you're me, is that you often want to change and often want to look at more time frame. I usually want to bring in as much data as possible. I'm often looking back at the weekly chart just to see the longer term trends and then start to see how this current move fits into the big picture. This is where you can start to get some of the longer term trend lines that may make sense. But I would tell you, generally speaking, the further back you're going, the less relevant the trend line probably is today. And I think that's an important concept to remember. Trend lines sort of have a shelf life, and it's hard for me to tell you exactly what that shelf life is because it depends. But I would say the further you go to the left, the less and less relevant that level is for where we're at right now. Same with support and resistance, right? Something that happened a month ago that is fresh in the market's memory, probably a lot of the same participants kind of keying in on a similar level, high probability. A support level from 4 years ago. I don't know what you were doing 4 years ago, but it was a different world for most of us. So probably a different feel on the chart. And I don't know if that exact price level may have meaning, 4 years later. So that is something generally that I would keep in your mind as well. The further you go back, the less important that level probably is, only because the market has a memory, but it doesn't have a perpetual photographic memory. It's got a limited memory, a limited attention span a lot of times. Great question, by the way. I gave you sort of a soft and fluffy, big answer, but I would say in general, look back and find the most important parts. That is really the subjective nature of trendline analysis. And I would encourage you to look at books like Edwards and McGee that do a good job of going through those levels in particular. Next question. Dave, now that the QQQ broke the 50-day, what are the odds that it breaks the 100-day? And what I so love about your question, and thank you for sending this in, is that it implies sort of thinking about if this, then that, which is a brilliant website if you're trying to automate different tools and you're an entrepreneur. I think it's fascinating. But the whole idea of if this, then that, thinking of an if-then statement sort of approach to investing, I think could be helpful, because what it does is it means you don't have to worry about all those other things, right? If this happens, then this other thing can happen. So I don't have to worry about that other thing because we're still at the first point, right? And that's where I need to set my alert or focus my attention. I love that sort of mindset shift of just focusing on what's actionable now. So looking at the QQQ, it has broken the 50-day. Today, as I mentioned, closing right at the 50-day, if not slightly above. So I think that's an important maybe asterisk on the question that you asked about. You were suggesting something like the what's the chances that it breaks the 100-day. The 100-day I actually usually don't show on my chart. Some people really like having them on there. I know Grayson Rose often has the 100-day moving average on some of his charts. I tend to simplify. I tend to like looking at less lines as opposed to more. And so if I have too many moving averages, I find all of a sudden I'm starting to get lost in the clutter and less having a clear, unbiased view of the price action. That's what I'm trying to do. So, having broken the 50-day, that doesn't to me mean, all right, then we go to the 100-day. That usually tells me to start putting Fibonacci retracements on the chart, if that makes sense. As long as we hold the 50-day, it's like I don't need to think about downside retracements too much because we haven't broken the very basic starting point of a corrective phase. Once we break the 50-day, that's when I think you do want to start putting Fibonacci trades. So for me, it's less about the next moving average that we hit and more about the next level. This is when I would think, okay, what is the next level of potential support? Where's the 200-day moving average, which I think is an important one? Looking to the left on the chart, are there any other support levels that I've not mentioned that may be of interest too? But breaking the 50-day basically tells me to start engaging downside objectives and thinking about the likelihood of achieving those. And that, as part of your question, I think is really meaningful. So for me, less the 100-day, I don't know if you need to be married to that, but if that is something that you have found helpful to identify some downside objectives, I have different ways of trying to answer that question. I think going through that thought process now, very healthy and very astute. Next question, Dave, how important are support and resistance levels versus indicators like MACD? And actually in your question, you had a lot more thoughts about, support and resistance levels. If we break them, how do I think about how important is that we broke a support level versus something like an indicator like MACD, which is less wiggle room and more like an absolute signal. So to be honest with you, I think they're both important. As I'm sure you would guess that I would say. I mean, if you watch this show enough, you're going to know probably that's where I would go with it, and that's right. I don't think that they are independent, and I don't think of them as one is more important than the other. I do have a general checklist, and actually in Las Vegas last week at the Money Show, one of the masterclass I did was a special event on the technical analysis checklist, and I will tell you, item 2 on of course I should know my list better than this. I think it's item 3 is support and resistance levels. Number 6 out of 7, if I remember right, is confirmation, which is where I would put something like MACD or PPO. For me, I don't have a very indicator-based approach. My main toolkit is looking at price and thinking about trend and moving averages and support and resistance levels and Fibonacci retracements. For me, that sort of market structure analysis and price structure analysis is most important. Indicators like MACD, I put at the end of my process as a way of confirming what I've seen with price. Now, other people flip that and they start with something like MACD or ADX and have a more indicator-heavy approach, and then look at price and volume and other things to kind of confirm what the indicators are saying. It is a different approach and just not mine. If you're looking for more people that have that kind of thinking in the stock charts kind of family, Arthur Hill comes to mind as a very systematic indicator-based analyst. Joe Rabel, who focuses a lot on ADX and MACD sort of indicators, I think could be very helpful. In our stock charts approach, our stock charts family, analysts that are a little more price and trend analysts, I would say like Tom Bowley comes to mind. Myself, Grayson Rose, I would think of as more price first and then indicator second. I don't know if there's a right answer to that. What I would tell you is finding your groove, finding your approach, and sticking with it consistently is what's most important. So I hope that I'm able to demonstrate like that. So for me, support and resistance levels are important or are interesting to me. The trend is what's primary importance. And whether that's analyzing it based on Dow theory or based on moving average analysis or MACD, I think that's pretty vital to your approach. Finally, how useful are long-term moving averages? It's a very moving average type of mailbag today. How useful are long-term moving averages such as 200, 400, and 600-day in addition to the standard 50 and 200 days. You can probably guess from my earlier answer, I don't even have the 100-day on there. So longer term ones like 200, 400, 600, 200, 100% important to me. 400 and 600 day, I don't look at them a lot. And the reason is this: on a daily chart, a 600-day moving average just seems a little extreme to me. I would much rather look at a weekly chart and look at a 150-week moving average, which is kind of in the similar sort of realm and time frame. But that's something that's more of my weekly chart type of analysis. There, I'm wanting to look at 5 to 7 years of data. I'm trying to look at big long-term rotations. The daily chart, I like to keep it to moving averages that are most relevant to the daily time frame and a 1 to 2 year look that I'm paying attention to. So the 50 and 200 day are about as much as I would want. Even look at this 2-year chart of the QQQ. The 200 day really doesn't have a lot of activity. It's ended up being a pretty meaningful level for the Qs, but overall, I think, I don't think you need anything longer than that to tell the story of the market over the last 2 years. Now, if I'm looking at the last 10 or 20 years, then I'm going to want to bring in way more data, and I'm going to want to look at longer term moving averages, but I'd much rather use weekly and monthly charts for that analysis and no longer a daily chart. I hope that makes sense to you. And again, it goes back to the weekly, multiple timeframes. ACP, by the way, the ideal place to do that analysis. That's why on my ACP view I'm showing you here, I have a weekly chart and a daily chart. The weekly chart has the 40 on 150 week moving averages as opposed to my daily, which has the 50 and 200 days. So I'm scaling the moving averages based on the timeframes. That's where I would encourage you maybe spend a little more time as opposed to thinking about really long-term day counts on your daily moving averages. Folks, we need to wrap the show. Thanks so much for asking all those great questions for the mailbag. We need to go to the 3 and 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. We're going to start with a chart about offense versus defense. And I'm just looking at the last year to show you how the market has sort of traversed 2023. Offense over defense very quickly in January. And remember what a change that was from the deterioration in the end of 2022. Consumer discretionary dramatically underperforming consumer staples. That changed right around the holidays. And in January, it was offense over defense. Really showed you how 2023 was shaping up in January to be a pretty strong year. Now, in February, March, April, May, really, you saw sort of this rounded bottoming pattern as defense, like consumer staples, really starting to do well. This chart of Hershey's earlier, that's where there was really showing some strength relative to the XLY and other consumer discretionary names, which were struggling. Once again, offense over defense in May and then June and certainly July. From mid-July to now, though, consumer discretionary has been underperforming on both a cap-weighted and an equal-weighted basis. I think this bottom panel may be a really important one to watch because we're really close from where this chart certainly seems to be telling us that defense is outperforming offense, or the other way to think of it is that investors are getting defensive and they're taking additional offensive bets off of the table. That ratio continues to go lower. That would tell me to get more and more defensive in my thinking and certainly in my positioning. Chart number 2, the chart of gold. We didn't get to this in the market recap, but I just want to highlight here. If you look at the GLD, take the low from November of 22, which is when the GLD actually bottomed out. Take the high from May of this year, which is when, for now, gold has made its high watermark for the year. And again, this is a retest of all-time highs for spot gold. You can see we pulled back 38.2% of the way, almost exactly, to around 175, 176. That's where we hit a bottom in June. We bounced back up to 184, and now we're right back down testing that same support level. Now we have the additional support of the 200-day moving average, which means gold is really at an area where I would probably expect some sort of bounce higher. We're testing the June lows, we're testing a Fibonacci support level, and we're testing the 200-day right all around this current price, or just below the current price levels. The momentum overall has been weak. It's been underperforming. That's all true. But if I'm a contrarian, which I do have a contrarian hat here somewhere, if I had it and I put it on, I would probably be thinking, gold popping higher because of this test of multiple levels of support. Finally, candle charts are really helpful. And again, when I spoke at the Money Show last week, one of the questions I got that I thought was really good, we talked a lot about my checklists and about different trend analysis tools, and looked at a lot of 6 to 12 month charts to think about that medium term to long term time frame. And I got the question about candlesticks. What about candlesticks? How do they fit into your process? And my answer was, I think they're important, but they're at the end. I think of them as some sort of a confirmational tool. Let's analyze the trend. Let's see where stocks like Walmart and NVDA are coming from. But then if we see a particular candle pattern, that tells me something interesting is happening on the short term, on the tactical time frame. Just today, Walmart, which reports earnings on Thursday before the open, I believe, bearish engulfing pattern, up day on Friday, down day on Monday. Today's open to close range, the body of this candle engulfs the first day's body. That is a short-term sell signal. The opposite happened with NVDA and some of those semiconductors I mentioned in the market recap. Bullish engulfing pattern with day two engulfing day one. So you have semiconductors giving a bullish candle pattern. You have a stock like Walmart coming up with earnings on Thursday, a bearish short-term pattern. It tells me maybe the jaws come in a little bit and we get a bit of mean reversion here over the next 1 to 3 bars. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the Final Bar. Don't forget our special YouTube live Q&A coming up this Wednesday at 1 p.m. For StockCharts.com in Redmond, Washington. I'm Dave Keller. Be well, stay safe. We'll see you tomorrow.